Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. Market rotation and liquidity, from macro debt to microtech and retail. This video presents a direct informational narration of the source document. We're tracking a massive wave of money moving through the markets right now. As the source document lays out, macroeconomic debt fears are cascading all the way down into specific microsectors, triggering a fascinating wave of volatility.
Here is the agenda. First, the crypto and gold surge, followed by U.S. debt and liquidity. Then, we'll look at the AI hardware rotation, the institutional tech stock sell-off, semiconductor stock updates, and finally, a retail sector earnings surprise. Basically, the source document analyzes how macroeconomic debt fears are driving funds out of the AI space and into crypto and gold, directly impacting specific semiconductor and retail stock movements.
Section 1, Crypto and Gold Surge. The source notes a massive and sudden outflow of capital from the heavily crowded AI hardware sector. That money is flowing directly into crypto assets and traditional safe havens. To see the sheer scale of this, just look at Bitcoin. The source document notes it hit a multi-month high of $79,500 before pulling back to around $77,000. Looking at the cumulative data, the document highlights a massive 25% weekly gain for Bitcoin. At the exact same time, gold broke out past the $2,600 mark, recording a 3-week consecutive rise. This strongly signals that a new bull market atmosphere has firmly taken hold in these alternative assets. Section 2, U.S. Debt and Liquidity. This brings us to the analysis from Nomura Securities cited in the source, which explains the macroeconomic fears driving this sudden shift. The market is clearly afraid that U.S. long-term fiscal debt is spiraling out of control. If long-end Treasury yields keep spiking, the fear is that the Federal Reserve will be left with no choice but to step in as the buyer of last resort. This means they would have to initiate yield curve control or quantitative easing to cap those Treasury yields and inject liquidity to monetize the debt. This quote perfectly captures the dynamic. Global capital is front-running the inevitable monetization of debt in a looser liquidity environment. The market is aggressively front-running a Fed pivot, but the source warns there's a huge catch. If inflation stays sticky and the Fed doesn't ease as expected, the market could face a severe correction. Section 3, the AI hardware rotation. Let's look at the direct effect of this macro shift, specifically the aggressive rotation out of AI hardware and into crypto equities. The divergence is staggering. Crypto concept stocks are surging, with MicroStrategy jumping 13.7% and Coinbase rising 8.2%. Contrast that with the struggling semiconductor SOX index, and the document points out a complete reversal of the capital flows we saw earlier this year. Section 4, Institutional Tech Stock Sell-Off. The document references a Financial Times report detailing how institutions are handling this. Citadel successfully realized massive second-quarter AI profits. A Friday letter from Ken Griffin indicated no plan to defend these prices. They sold off 80% of the fund's risk exposure through over 100 block trades, liquidating over $4 billion in market value. The source document notes that this sharply contrasts with their public bullish statements from just 10 days prior. However, the source observes a silver lining here. With this massive 80% structural selling pressure now largely released, semiconductor stocks may soon return to their normal trading trajectories. Section 5, Semiconductor Stock Updates. Let's look at the granular impact on specific semiconductor companies. The document breaks down 3 major players. First, Micron is falling despite the fundamental necessity for their AI memory and the company running at max capacity. Next, Marvell has a Google partnership, but since earnings are 12 to 18 months out, it saw heavy profit-taking after peaking at $255. Finally, Broadcom is reportedly in talks for $100 billion in financing. Because of those financing ambitions, the source notes that Broadcom's credit default swaps, or CDS, hit all-time highs. Because Broadcom carries a heavy debt load from previous leveraged buyouts, the company is highly sensitive to the high interest rate environment. Section 6, Retail Sector Earnings Surprise. We pivot to unexpected strength in the retail sector, specifically Ross Stores. The source document details a massive earnings beat for Ross Stores. Q2 revenue hit $6.3 billion, and their EPS came in at $2.66. This EPS includes a 60-cent tariff refund and easily shatters the 71-cent expectation. The growth metrics are phenomenal. Revenue grew 13.9% year over year. The document also highlights 10% same-store sales growth for 2 consecutive quarters, leading to an upgraded full-year guidance that implies a 31% profit growth, their strongest since 2022. The source document concludes with a final observation on this dynamic. Despite the impressive retail surge, the post-earnings sell-off in consumer giants like Walmart appears to be a deliberate institutional move to secure profits and immediately rotate capital into lower-priced semiconductor assets.